Hey everybody, Ben Nelson, the Everyday Real Estate Investor here. Hope you're all doing well. Hope your New Year's is started off on the right foot and you're moving towards your goals. And we are going to talk again to Grant Schroeder, Academy Mortgage, to kick off our year and just find out where's the market, how's the year starting out, what do you see coming this next quarter, next year, for interest rates and lending and all that, just because we got to stay on top of that, and so we can strategize and make the right calls in our investing.
Exactly. Thank you for having me, Ben.
Yeah, appreciate it. So this is good for me. As you know, my year has started off a little different, and so I have honestly, I haven't paid attention to anything at the last couple weeks, and I don't have a clue where interest rates or any of that stuff is at. I'll get back there, but yeah, give us a quick update on what you're seeing so far this year with rates, activity, some of that stuff, just to kind of get us caught up on where we're at right now.
Yeah, as far as interest rates, people with higher upper tier credit, 740 plus, really conventional rates are almost at a 5 handle, kind of between a 6 and a 6.25 space. VA, FHA, more of your government-backed loans, are high 5s. Our Academy Investor loan is now in the low 7s, moving towards the high 6s.
Yes.
Very nice reprieve we were high 8s, low 9s there for a little while.
Yeah.
That was a little crazy, November, December. But still had people buying, still had people winning on offers, knowing that, hey, they're going to refinance in 12 to 18 months, if not sooner, if the rate of inflation comes down even faster than we anticipate.
Yeah, which I think we had talked about on our last, I don't remember when our last update was, but it was right around that time, I think November, December. And we were talking about how it was a good window to buy just because of where interest rates were, and because it had caused kind of this lull in the market, this double whammy of seasonal plus high rates. It was a great window to buy. And so on that note, now we're starting to see that probably was accurate, right? We're seeing a lot of activity on the market. Tell me about some of the buyers you've been working with that have had all these, multiple offers again, things like that, right?
Yeah, I mean, definitely the last 4 or 5 months have been kind of a golden opportunity to buy, where people are maximizing the seller credit they're getting. They're one-on-one in negotiations with a seller, winning more on their terms because so many people are priced out due to affordability with the higher rates. Knowing that, hey, if the numbers work now, or I can sustain the property right now, I'm going to refinance in 12 to 18 months, and that added cash flow is just going to be icing on the cake at that time.
Right.
We kind of anticipated interest rates coming down, and kind of my advice to people not wanting to be overly optimistic was I thought we could be very much in the mid-5s by Q3, Q4, towards the end of this year.
Yeah, which I think we talked about. I think that's the target that we had said when we last had our
I think
update.
Neil Balwa you had sent me something.
Yeah,
he also thought the same.
He did, yep.
A lot of that is predicated on how quickly the rate of inflation comes down. And the last 3 CPI, Consumer Price Index reports, have been favorable. That's why we've seen rates come down from on primaries mid-7s now to low 6s in just 2.5, 3 months.
Yeah.
That has led a combination of, I guess, New Year's resolutions and the lower rates and affordability. We've seen quite a big uptick just in the last week. We've had 11, 12 applications, lots of people now wanting to take action, but we're also seeing at the same time, not just us, but we're seeing like a 25, 26% uptick in the last week or two in applications across the mortgage industry.
Yeah.
I mean, just here in the Portland metro, we only got up to 2.5, 2.6 months supply. It wasn't like Boise or Phoenix or Seattle that were hitting 4 months.
Yeah, which really isn't even 4 months is still.
So was it 4 to 6? Is
it's like equilibrium. Yeah.
And just this past week, we had a buyer that made an offer on just a regular single family home in Portland, 13 offers, and another one out in Hillsboro, just outside kind of Portland metro, 8 offers on that one.
Yeah. So back to very early. So last year, I remember thinking, your spring rush tends to be late March, April, May. That's kind of when you see that uptick. And last year, February was insane. And then we saw this huge, downswing, May, June, and then it's just this huge swing in the market. And so now we're off and running again here in January. We're only halfway through January, and already in multiple offers, and that's not like a couple offers. That's back to what we were seeing last spring, like not even spring, like late winter.
And my
right?
advice to people was, I very much thought, what I've been telling people is, okay, I think 3, 4, 5 competitive offer situations by Q2 could be very much the norm. I didn't fully anticipate.
Do you want to amend that now?
I mean, I wanted to be more conservative, of course, but like, I didn't think we'd be. Hopefully, we don't go back to waiving contingencies and some of the to win offers. I certainly didn't think. There's still your one-off properties that draw a lot of attention or are underpriced on purpose, but 8, 12, 13 offers, that caught me by a little bit of surprise.
Yeah.
And they were well-priced homes, too. It wasn't like they were undercutting the market significantly. So that'll be very curious to see how that plays out in Q1.
Yeah, and is it just another one of these like short runs on the market, or is it going to be? Are we seeing what the trend's going to be for this near year again? And honestly, I would say I leaned more towards what Neil Bawa had said, and I was seeing a longer picture where this year was going to be, a little rough on the sales side, and it was going to be maybe next year when we started seeing rates and seeing things kind of balance out. But again, it's still early.
Yes.
We're only a couple weeks in the year, so it's you don't want to draw conclusions necessarily from a couple scenarios in a couple weeks. But yeah, it would be interesting to see if that is much sooner than a lot of people anticipated. So
I mean, my thought process and what we're seeing with data and a lot of analysts is thinking the first 6 months of this year from the volume of transactions in the real estate markets would be very similar to the last 6 months. I mean, last year was very much a tale of two markets. You had through June, it was still hot. You still had crazy offers, February, March, April, May, and then it was like the spigot got turned off, and it was like we were from a transaction standpoint, the number of homes that we're selling, we were at a recessionary level in the real estate market. Not from like prices dropping, but just from a transaction level. So that was very much the thought that might be similar for the first 6 months. Okay, as rates come down, the back half could pick up more. But very interesting to see it picking up so much.
And it'd be, I mean, we saw pretty I guess significant would be the pullback in pricing in a lot of markets. Portland, I didn't look in December's numbers. I just haven't had the opportunity to. But I think from May to I think it was November was about 10%. That's your $500,000 home. That's $50,000. It's a pretty significant change. And I know other markets like Phoenix, and I don't actually know what they went down, but I feel like it was more than that, 20-25%. But now, to your point earlier, prices being bid up over list, and so how quickly is that going to come back around? And it's just interesting because I always say there's always a reason to not buy property, right? But because what if the market does this? What if this? There's always an excuse. But now if you didn't and you held off, you're probably kicking yourself, right? You had a little dip that you could have bought in, and here we go back running again. Again, maybe. But it seems to be headed back into that direction with the momentum in the market, which again, quicker than I thought, but not super surprising because my thought has always been, inventory is still very, very low. And again, every market's a little different, but here in the Portland metro area, you mentioned 2.5 months. That's still very low amount of inventory. Builders kind of pulled back on breaking ground on stuff, and permits were down. So that's going to have an effect on inventory. And then between that and then my number was mid fives when rates kind of settled somewhere in there. I felt like we were going to be basically back, maybe not quite where we were last year with the craziness in the market, but a pretty good, solid selling market in that scenario, and we're pretty close to that. So.
And the key will be not so much just to touch mid fives, but to stay there for a couple months. I mean, the last 12 to 14 months, there has been so much volatility in the market, and that's
a good point.
Honestly leads in itself to higher interest rates because investors, with inflation being higher, with so much uncertainty, the servicing value on mortgages, that has an effect on interest rates that investors are offering because, number one, they don't know if they're going to get refinanced quickly, but they also don't know where the market's headed. And so there's some hedging done there. So when we get less volatility and we get, okay, we're solidly in the fives, we don't just touch it, okay, we bounce back up to 6. It's like, hey, we're at 5.5, 5.625 for like month, 2 months. So there's more tranquility in the market. Secondary investors feel safer. The spread on the 10-year and interest rates continues to compress, and that shows that the volatility is decreased. That's a good thing. We want to see that.
So there's a lot in there, I think. So number one, is there still margin in there for volatility that you think rates really should be down in the low 5s, but they're in the high 5s or low 6s because there's still that extra margin in there because of uncertainty?
There's still quite a bit of uncertainty. I mean, with an upcoming recession, it's not so much if, it's when it's going to happen. I think today the 10-year got down to like 3.35, 3.34. So still, I don't know, 220, 230 basis point spread between where conventional mortgage rates are and the 10-year. So as inflation subsides and that margin compresses even more, that's certainly a good thing.
Yeah. So we have a couple things that could potentially give additional downward pressure on rates. You know, as lenders are more comfortable with less buffer, right? Because volatility settles down, and then the the aspects of inflation and all the other factors that contribute to higher interest rates, we could have a double effect. We kind of had it the other way around, right? We had a really high interest rate or really high inflation. We've had all these things that they're trying to do to offset that, and then the volatility, lenders padding those rates because of the uncertainty, and so rates were maybe higher than they needed to be because everything was working against them, and so we potentially could have the opposite effect now. I'm speculating a little bit there, but it's possible, right? So
I've even seen forecasts by 2024 like being back in the mid to high 4s is very reasonable. 3% would be a little crazy. The Federal Reserve would probably have to be buying mortgage-backed securities again and to get there. But I think, it is nice to see inflation coming down, the rate of inflation coming down. Certainly, getting back to more stable mortgage rates would be really, really good for the housing market.
Yeah, and I think hopefully this is bringing perspective to buyers because, man, I remember buyers and even agents, honestly, that it's like, when rates first got into, and I think this was before last year when they started going, this was maybe like the fall of the year before. I think maybe they ticked up into like the low 4s for a little bit or something, and like meltdown, like, oh my gosh, we're in the low 4s, this is insane, what are we going to do? And, little did they know that we'd be in the 7s, like less than a year later. So I think it's good because it brings perspective back to agents, it brings perspective back to buyers and to sellers, and that like, hey, 3%'s not, we were there a long time, but we really shouldn't have been, and it's not normal. And so let's like reset the expectations a little bit on where mortgage rates probably should be hovering, and that's in that mid 4 to mid 5 range probably, right? Yeah.
Be healthy for the market. For your move-up buyers, which are your sellers, to have transactions, to have inventory come to market. The first-time home buyer market was almost eliminated the last 6 months because of where rates were at, and move-up buyers were not wanting to sell there and lose a 3% interest rate and go up to a 6 or 7% interest rate when so many people either kept their homes or the amount of renovations people are doing on their homes are turning them into rentals. I know we did that. Not wanting to give up a 3% interest rate.
Right.
But having those lower rates and making things more affordable will certainly help encourage people, the natural progression of a move-up buyer.
Yeah.
So most of the people taking action for the type of clients that I work with and the type of clients you work with, the last 4 or 5 months have been investors, have been house hackers who they're offsetting rent expense. It still makes sense to buy at a higher rate, rent out rooms, rent out another unit, cover your mortgage, pay less than you do in rent, or investors who are looking at a numbers approach. It's not, okay, just, the payment's this higher, the rate's at this. they were taking advantage, where your common home buyer a lot of times was sitting on the sideline. And we're
Yeah.
seeing that. I think that's part of all the pent-up demand now that's coming to market sooner than we even anticipated.
Yeah, for sure. I mean, we certainly felt that in some of the inventory we had with that. Hey, this is going to be an entry-level buyer product. It'd be a good price point. And they were all bought by investors, the ones that are sold so far. So it'll be interesting to see if, with this momentum we have with rates and some in home buyers coming back, if the remaining of those, it will go to first-time home, because that was the target market. It was not investors. It's a great product for an investor, but we totally thought that it was going to be first-time home buyers that would be all over it. So, and as investors, again, I mean, I think the smart, well, I shouldn't say that, maybe. People that can see the big picture, investors that can see the big picture, it's really easy, right, to get caught up in interest rate. And I think that a lot of buyers, both investors and traditional home buyers, especially with the history of where rates were at, they don't even necessarily do the numbers, right? They just say, man, I could have had a 3.5% rate. Now it's 7.5%. Like, I'm not going to buy now. And they don't even like pencil it.
Yeah.
Like, it could still make sense. You just have to adjust your numbers based on where rates are at. Make it make sense now. And then, if rates come back down, then you just have that extra cash flow when you can refinance.
I saw many examples out there where just doing a comparative analysis between, a 3 to 4% interest rate and overpaying 8 to 12% on a home, like many people did in 20 and 21. But looking at, back half of 22, rates are at 7, but you're getting an 8 to 10% discount on a home, and comparing the monthly payment, and it's like you're off by less than a couple $100.
Yeah.
And everyone, just like you said, looks at the headline rate, and they just freeze and they stop and say, okay, I'm going to wait. Because there's, like you said, there's always going to be a reason not to invest, not to take action.
Yep.
Whether it's real estate.
And those headlines give you a really good reason every time, don't they?
Very, very true.
Very.
Whether it's too much competition in 2021, early 22, or rates are too high. Well, there's always going to be something, and those who are taking action or did take action are being rewarded for that.
Yeah. And it's not that there's not necessarily truth in because there's if you dig on either side, you can find all the positive spin, and you can find usually a lot easier the negative spin. And so you have to take it all in, and you have to make your own decision from there and judge for yourself. And there's usually truth in both sides. You just have to say, is there a conclusion, the conclusion that I believe to be true, right?
And it's very easy to look at headlines. I mean, we tend to not follow news as much or follow the eye-grabbing headlines. It's more, I like to follow people like Logan Motoshami on Housing Wire, or the Bigger Pockets, their economic podcast On the Market, where it's a data-driven approach. Because numbers and what's happening in the market, whether it's inflation, mortgage rates, like the numbers don't lie, and the trend we're seeing not only helps us understand what has happened, but also what we could be looking for going forward. It's not this guessing game and
the context and the context of the numbers, right? Because you can make a data say almost anything you want, right?
Yes.
I so many headlines. I talk about this all the time too. Year over year sales being down, whatever it was, 40% or whatever.
People love
for a while.
These percentages.
Yeah, and it's just like, okay, well, but what's the long term trend? And like, all of that stuff matters, but it's not a good headline, right? So, that's a big dip. But what's normal? And is that it was a year ago normal? Are we measuring it against a normal number? Well, no, we weren't, right? So it's like you have to look at the big picture and not just. You could say the same thing with foreclosures. Okay, foreclosure filing, I don't remember but they were up, and it was percentage-wise.
It was huge.
It was a huge number, but it's like, but it's
still
the
below
lowest
2019
number
levels.
it's ever been in I don't know since they started recording it, but if you compare it to, even just the prior years, it's lower. And then you look back to the financial crisis, and it's like a fraction. It's like, this is nothing to worry about. So, numbers are great. They can also be super deceiving.
Yeah, and it's also I mean, whether if you're a flipper, you're a wholesaler, okay, you have a little bit more of a shorter window, shorter view of things, but certainly most of the people we're working with are longer term buy and hold investors. And when you're looking at the long term, that buying real estate and holding it, buy real estate and wait, don't wait to buy real estate. That plays out over time in your favor.
Yep, so. Absolutely. Yeah, and again, I think that's where people maybe got a little bit afraid to buy because, I don't want to buy on the dip and then, which I get it. Yeah, I mean, ideally, we all buy at the bottom and ride it up, right? That's, okay. But is that realistic? Probably not, unless you get lucky. You can do certain things and look at certain things to try to give yourself a good chance for that and buy into emerging markets and things like that. But yeah, timing it perfectly is never going to happen. And again, you can get, just like the interest rates, you can get so focused on one piece that you ignore all the other positives, right? Okay, well, yeah, what if I bought now and the price went back, down 10%? Okay, well, are you selling it in a year? Probably not, right? Yeah. I mean, if that's your plan, sure, be concerned about it. But if your plan is to hold it long term, who cares? Yeah, okay, yeah, would have been nice to get it for 10% less? Yeah, but now you own something, someone else is paying for it anyway. With paying rent, and you're getting tax benefits, you're getting the appreciation, and you own more real estate. I mean, so don't get so caught up on one piece of your investment that you miss all the other aspects, all the other benefits.
Yeah. Don't miss don't miss the forest for the trees.
Yeah, exactly. yeah. So, where do you see coming here in the next quarter, this year? I mean, we talked a little bit about what you think on interest rates and when you see them, or what you see them coming down to. I don't remember if you mentioned what are your thoughts on the window, and maybe touch on inflation and stuff in there as well.
A lot of what I've seen from data and different analysts that I listen to is early May 10th. Shelter inflation is lagging and still relatively high. So CPI might be, the drops might be very minimal over the next couple months of readings. Bond investors, where mortgage-backed securities, where rates are based, are very much looking at inflation. There's lots of other factors they're looking at, but we will not probably see as big of a meaningful drop in the rate of inflation as we have in the last 3 readings, November, December, January, until we get to about May. I still think these next couple months are a really good time to buy. We're still seeing investors or people buying on one-offs where they're still one-on-one with the seller in negotiations, maybe unique property, but a lot of that mainstream home buyer, your typical 3-bed, 2.5 bath, well-located, that's getting a lot of activity right now. But I definitely think for many properties, as I've talked with many clients about this, that window of opportunity is closing a little bit, where by Q2 you will be back to 3, 4, 5 offer competitive bid situations as rates just continue to improve.
Yeah,
through the year.
Rates coming down, and then here we go back into the spring, summer buying market. So I think I see the same thing. I mean, I think again, I was seeing this year maybe being a slower year, but I think we may be right back into it a little bit quicker than we had thought. Got to keep an eye on what inflation's doing and all those things, and the economic picture is changing all the time. But I think I agree with you on that, and it'd be interesting to see how it plays out.
It'd be very interesting how, the landscape has changed a lot from last year. I don't know what it looks like from a realtor licensing renewal standpoint in the state of Oregon, but I saw a statistic talking with some other loan officers that loan officer NMLS renewals were down like 38-40% in the state of Oregon.
I have not looked at that. That's
what that looks
question.
Like in other markets, but that, we kind of needed a little bit of a purging of the ranks because there are so many people, and it's an opportunity to serve clients better and help and stand out more as a lender, more as a realtor. So there's still lots of competition out there, but there's looking like there's less because of the way the market has been. So I'd be kind of curious how that plays out.
I haven't looked at that, but I would venture to guess license renewals for agents is probably down over the last 6 to 9 months. Yep. not for me though. Let's go.
Yeah.
Lots of opportunity out
Because
there.
your guys' license renewals they're different times during the year.
Yeah.
Where it's easier to measure, I think, with lenders because we have from like November 1st.
Oh, it's the same date for everybody.
It's the same time end of the year.
A lot easier to measure. Yeah.
Yeah.
Yeah. Very good. Let's see. I think we've touched on pretty much everything. I had one other thought, but now it left me. So, appreciate you being here, giving insights. Any last thoughts as just some observations or anything like that before we sign off?
I'm excited for the year to come. I mean, looking at investments for myself, but also helping clients continue to build generational wealth, put a plan together. I mean, this is a great time. A lot of clients, February, March, April, we're looking through tax returns before they file, getting them ready for, okay, they want to buy 1 or 2 or 3 this year, putting that game plan in place now. I think for those who are keen on taking action, it's going to be a very good year. It's going to be an exciting time for people willing to take action, even with media headlines, even with potential recession looming towards the back half of the year, beginning of 2024. There's still lots of the opportunities that are going to be out there.
Absolutely, yeah. And just a quick touch on that. Recession doesn't necessarily mean prices coming down, right? So people hear that and I think that's what they think, but we've talked about that before, I think, too, that, just because the economy is in recession doesn't mean house prices are going to come down. In fact, typically it means the opposite.
Yeah.
And there's a lot to unpack there that we could, but yeah, there's definitely not necessarily a correlation there. And just to touch on the other thing you said, so again, I always talk about having a plan, know what your strategy is. Just buying real estate is better than not buying real estate at all, but having a plan of what you actually want to accomplish in your real estate investing, that's a better place to start, so you can have actually a strategic plan of how you're going to go about doing that, and then including your team in that. Obviously a real estate broker needs to know what's the big picture. I think a lot of people forget that you need to include your mortgage professional in that as well, because there's things that are important to that, like looking at your tax returns. And you want to file your tax returns. That's in a way that you can benefit from the tax code and reduce your tax liability. But sometimes that's detrimental to your strategy with being able to buy. And same token, you buy one and, I didn't know you wanted to buy another one 6 months from, we would have done something differently, right? So the big picture is really important. Don't just you want to look at the step in front of you, because especially if you're starting out, sometimes the big picture is overwhelming, but you still want to discuss the big picture, because you could be putting yourself in a spot to not be able to move forward as quickly as you are wanting to.
Yeah, always good to strike a balance between being tax advantaged, but also income and underwriting advantaged. And that's one of the things we sit down and we talk through with people. There are certain things we get to add. You can still show a net loss or net income loss on your tax returns, like after real estate write-offs. But there are certain things we get to add back, like mortgage interest, property taxes, insurance. The big one being depreciation. It's an awesome tax benefit, but you also get to add it back as income for income qualification. So knowing what you can write off and win on taxes and win on income qualification is really important. So it's much better for me to be able to see a draft up front and help advise you a little bit as being a member of your team, instead of looking at it in the rearview mirror after you've already filed. Right.
Nothing you can do at that point. So, yep, absolutely. So, very good. Yeah. So have, your team member, your mortgage professional is very important. So, if Grant works in your state, don't call anybody else, call Grant. But otherwise, find a mortgage professional that works in the state that you're investing in. Make sure they're working with real estate investors. They understand all those nuances, so that they can guide you appropriately, right? Same thing with the real estate agent. They should also be an investor, so they know how to help you in that way. And from an experience standpoint of actually being an investor themselves. And on the tax note, not sure when, very soon though, because tax season's coming up. I'll have my CPA on here as well, so we can get some high-level tax, not advice, because you have to talk to your professional about that, but just some ideas and information around around taxes and tax strategy, and some things to kind of just get your mind thinking about things maybe you don't know that you can do with real estate and your taxes, because man, there's a lot of great things you can do with taxes, and I think people don't always understand that the tax code is actually your friend if you use it appropriately. And write-offs are not bad. They're not illegal, right? They actually are written to actually tell you what the government is telling you what they want you to do by incentivizing you with the tax code. So be looking out for that one. That's going to be really insightful, I think, as well. And then we'll have you back on here in a little while, and we'll see if your crystal ball was right. Thanks again for coming and for the update, and we'll chat with you next time.
Sounds like a plan. Always good to be here, Ben.
All right, thanks, Grant.